So today I thought I'd do something a little bit different. Normally when I'm posting videos, I'm posting about stocks that I already own or that I have already bought. Today I thought I'd share with you with 3 stocks that I'm currently looking at that I'm seeing as potential opportunities and I'm quite close to buying them. I'll go through the reasons why I haven't bought them on the video, but I thought I'd mix this up because I'm actually letting you know things I'm looking at rather than what I've already bought, which is a little bit different than normal anyway. So hope you enjoy this Friday video, guys. Let's get started. Now, just a quick shout out, if you do want to see free exclusive videos this weekend and you've got a lot of free time, join the Patreon, links in the description, £5 a month, and you get some exclusive videos on there from me and also a way to support the channel as well. But we'll get on to these 3 stocks. So the first stock I'm looking at is Starbucks. There's kind of 2 big blue chip companies on this list, and also there's 1 UK company on this list. So Starbucks, a mega company, everyone knows Starbucks, 103 billion market cap company, currently trading at 24 times earnings and paying a 2.49% dividend yield. Now, since coming public, Starbucks has performed absolutely amazing, up 26,779%. However, in the last couple of years, the stock has stagnated quite a bit. If you look at the share price from where it was in July 2021 at $121, the stock is actually down 24% since that time frame. So the stock hasn't really performed that much in the last 3 years and has lagged the S&P 500. Now, Starbucks is a very easy business to get your head around. Obviously, everyone knows Starbucks. They open up these locations, they serve very expensive coffee as well as other products, but they are very popular. You stick a Starbucks down anywhere, the next day there'll be a big queue at that new Starbucks. And it's one of those that people say there's not much of a moat around selling coffee. I disagree, because you stick a Starbucks somewhere and you'll get that queue for Starbucks. It's crazy the amount of people that cannot survive without the Starbucks. So yeah, I think that this is a very easy stock to understand, really easy business to understand. They just keep opening up new stores worldwide, and if they ever need to, they can update the prices and increase them, or they could potentially offer new products. So yeah, I think Starbucks is a very secure business for the next few years. Not a stock that I would expect crazy returns from in the next few years. I'd expect maybe 50 to 100% return in the next 5 years, and as well as that, you'll also be picking up a bit of a dividend in that time frame as well, and a dividend that will grow as well. Now, we know that there's been a tough economy out there at the moment, but Starbucks is still performing quite well. Now, obviously, if you look at the last earnings, it does look like they missed the EPS. Well, they did miss the EPS and they missed the revenue. However, they're still moving heavily in the right direction, and when you look at the revenue, it's still growing 8%. This is very good growth, especially for a company that's trading at 22 forward times earnings, and as well as that, they are going to be returning that through share buybacks and also increasing that dividend, which is what you want to see. Now, looking at Starbucks, like I said, it is off its 52-week highs, it is off its all-time highs, so it is looking like it's on a bit of a downtrend at the moment. And is that creating a good value opportunity? Not always a share price going down is a good opportunity. So we have to check the valuation with Starbucks. And when I look at a P ratio right now, like I said, it's currently trading at 22 times forward earnings. On a trailing basis, it's currently 24 times earnings. So if we look at what Starbucks has historically traded at, it's normally traded above a market premium at 25 times earnings up to 30 times earnings, as you can see here. The only time it really dropped way below that was in 2018, but that was very close to a stock market crash during that time frame. Obviously, we have the COVID situation there, and even during the 2022 stock market crash, the lowest this actually got to was 20 times earnings. So there's only really one time that it's actually fallen below 20 times earnings. So I would not expect to pick this business up below 20 times earnings unless we were having a major stock crash, which by then there would probably be so many opportunities out there to buy. So realistically, I don't think I'll ever get this premium company probably below 20 times earnings. So the fact that it's currently around 22 forward times earnings looks not too bad at me for a very solid business. Now, with Starbucks, yes, it is on a dip and it is more towards a lower historic PE times earnings. The only thing with Starbucks is that I potentially would like it around about 5 to 10% lower. So this is on my watch list, that if it drops another 5-10%, you probably will see me actually pick up a position in Starbucks. So I'm looking around about the $80 to $85 range for Starbucks is where I'd start a position. So yeah, I think this would be a great addition into the portfolio if I could buy Starbucks in that sort of range. So I am watching this one very closely, because it would not be too hard to see Starbucks maybe drop another 5 to 10%, and I might pick some shares up there. So Starbucks is the first stock. The next stock on the list is Tesla. I actually hovered over buying Tesla the other week. I was very close to buying Tesla. When it dipped into the 52-week low range of $152 last week, which was around this time frame here, the stock did recover slightly on that day, but I was very, very close to pulling the trigger when it got into that $150 range. And even though I've been very negative on Tesla in the last year, there's a certain point where I go, okay, the risk to reward is here. I'm going to buy some shares in Tesla. And we know Tesla has had a tough time frame in the last 3 or 4 years. It hasn't really performed that much on this share price, and if you've been in the stock for the last 3 or 4 years, you're more than likely flat on that position or you're down on the position. So it's not had a great time, Tesla, but that's obviously because it has been on a fantastic run prior to that, and I think it's just had a bit of a valuation catch up, and then obviously we've had the situation with the higher interest rates, and that's obviously affected something like a expensive purchase like a brand new EV car. So there's understanding why the share price hasn't performed from a valuation point of view, and also from the macro point of view, you can see why Tesla hasn't performed that well recently. But we have started to see the positive news starting to come out with Tesla, which is showing me that we are potentially near a bottom in Tesla stock. We've seen them starting to hike up their prices again, which is a sign that we are getting closer to a bottom in the car sales. Also, we are seeing more people be bearish on Tesla. I always think when everyone's bearish, we're near a bottom of a market. The other thing is that the financials should start ticking up towards the back end of this year. We are expecting to go back to growth and EPS growth, which is the key drivers for us to have a successful business, is to see profit and revenue grow. And I think we might see that at the back end of the year. And in 2025, I would expect that to start coming back. As we start seeing the interest rates cut a lot more, I think we could see a rebound in the stock. And obviously, even though it could be another tough 6 months for Tesla, I'm obviously a long-term investor. I'm looking at this from a 3, 4, 5 year point of view, and all I can see in the next 3, 4, 5 years is EV sales getting stronger and stronger, as well as other parts of the businesses, like the solar parts of the business. If they can get the self-driving with the free trials they're offering, get more subscription sales in from there, it will look good for Tesla in the next 2 years. So yeah, I was actually very close to buying Tesla. On a PE basis, it is the lowest it has ever been. But saying that, Tesla only came profitable in 2020, so we can't really use a PE ratio. But looking at the numbers at the moment, if we do start seeing Tesla go back to 10+% growth, analysts are actually forecasting 19% growth in 2025, and the EPS starts going up a lot more, I think that this might be worth buying for the longer term. By the way, I also got asked about BYD as well, and I've got to say BYD does look very appealing from a profit point of view and a revenue point of view, and the fact that this is also trading at 15 forward times earnings is quite scary. But I just got to the point of view with BYD is that as much as I think it looks very attractive at the moment, probably more attractive than Tesla to be fair, I've got to say, I just don't know if I could add another Chinese stock into the portfolio. So I thought I'd just mention that quickly on the back end of this Tesla part. Moving on to the next one, Watches of Switzerland Group. I am very much considering buying a new UK stock, which is Watches of Switzerland Group. We talked about 2 stocks that have struggled in the last 2 years, but that's nothing when you start looking at Watches of Switzerland Group. They have had a horrible time since 2021. If you look at where the stock's peaked at the back end of 2021 or the start of 2022, the stock is actually down 75%. And year to date, the stock is down 46% year to date alone. And we're only in, the end of March, the start of April. That's massively underperformed the market. And anyone holding these shares has suffered big time here. But it is creating an opportunity for people that don't own the shares, I feel like, at the moment. And the fact that it's only up 16% since its IPO in May 2019 is crazy to think about. And so we're at 859 million market cap, 8 times earnings. Watch of Switzerland, I'm sure most of you guys have seen this on the high street in the UK or even abroad now. They have expanded to Europe, and US is a massive expansion plan for them. They obviously sell watches. A lot of their revenue does come from selling Rolexes, but they do also sell other watches as well. Now, watches at the moment have been suffering, once again, high interest rate environment. Sales have been a lot weaker during this time frame. People have cut back the spending. Also, 2021, everyone had that free cash. Everyone went and bought with all that free cash they had from not being able to go on holiday. Few people went out and bought a few expensive products. Maybe they bought a new car, bought a new house, bought a new Rolex. And we've seen that tightening of spending in the last kind of 12 months. And also that high interest rate environment where people are being more cautious about spending the big money. Like I said, I think we'll see the higher spending come back once we see these interest rates drop. But you can see the effects that this has had on the second-hand watch market. If you look at the chart here, you can see the rise during 2021 into 2022. And as soon as we start getting those higher interest rates start kicking in, you can see the effects that it has had on the high-end watch market. But that's been an awful downtrend. But if you do start looking in the last 6 months, This year we have started to see a bit more of a flattening into this market, which is a positive sign that we could be near the bottom. And also, if we do start seeing those interest rates cut, I think that's where we start seeing some of the recovery in this market. Now, I could ideally wait for some signs of recovery in the market, but we know what the market is like. It's future thinking. So if we do start getting those interest rates cut already, I think that by then we probably already see the share price starting to rebound, which I think we might miss this opportunity here. Now, the big thing that does worry me about Watches of Switzerland is that obviously they don't own their own products. The fact that they resell someone else's products makes me a little bit nervous that, Rolex can turn around at any point and go, yeah, we're not giving you any more, or we're limiting your stock, or something on them sort of lines. That always does worry me a little bit with the Watches of Switzerland part of it, but I don't know if I can see Rolex doing that. I think that would just affect them too much, but I've always got to take that into consideration. But when you look at the recent financials and you look at the share price and how much it's been destroyed, you'd think there'd be more weakness in their actual earnings. If you look at the actual earnings, yeah, I mean, they're obviously a little bit disappointing, but, constant currency is down 1% on a revenue point of view. Not terrible. When you look at the US market, which obviously is the best performing economy out there at the moment by far, above a lot of European economies, the US part of the business is actually still doing okay. 8% up in constant currency, as you can see here. The big thing is like the UK and Europe. That's what's affecting them. That's down 7%, as you can see here. And when you look at the profitability point of view, the profitability is only going to go down from 104 million to 88 million. They're going to still be throwing off a good amount of profitability as well. It's not like this company is going to go unprofitable overnight, which is still pretty positive. And if you look at the expansion plans for the company going forward, a lot more of the focus is around expanding into that US market. You can see here, they're actually expecting the US revenue to grow by a CAGR of 25% to 30% from financial year 21 to financial year 26. And that's by opening up a new pipeline of stores, as you can see here. And they expect their US business to come as big as their UK business. So that's what they're really focusing on at the moment. And if you look in the point of context at the moment, if you look at the Q3 update, the UK and Europe business was 22 million and the US business was 175 million. So yeah, if that can come more part of the business that's still doing very well in this downturn, I think that would be very good for Watches of Switzerland. And as well as throwing off still very good profitability, the balance sheet has been getting stronger and stronger. They now sit on 13% debt to equity. This was a lot higher than where they IPO'd in 2019, where it was 348% as well. And obviously the debt that they've got left on the balance sheet, which is 6 to 8 million, they're going to make that up in profitability this year alone. So they could easily play the rest of the debt off, or they could take advantage by moving towards a dividend or buying back shares, which would be very good at these sort of levels as well. So from a profit point of view and a balance sheet point of view, this has been strengthening up quite nicely. And just to give you a little bit more confidence into the stock, you actually had the chairman of the board, as you can see here, picked up 186k worth of shares during the 8th of February as well. And if you actually look at the price he paid £3.91. If you actually look at today's price at the moment, it's £3.58. So you're even getting it at a discount to what the chairman of the board bought as well, his shares at, which is obviously pretty impressive. And then just looking at a valuation point of view, obviously we're going to see the profitability drop. So we are currently at 8 times earnings, but even then it's only just going to go to around about 9 times earnings on this company. This company's never traded at this low on a P ratio. So if you actually look at where the company kind of IPO'd in 2019, actually this takes us back to the latest of 2021. It used to trade at like 30, 40 times earnings, you can see here. During 2022, we even got to 18, 16 times earnings, and then we entered more towards the 13 times earnings, and now obviously we're down at the 8 times earnings. So this is the lowest that it's ever traded at on a PE basis, although we don't have that much data because it's only been a public company for around about 4 or 5 years. So we don't have that much data, but it is a lot lower than where it used to trade at by a good margin. And I think if we are going to see Watches, this is probably the worst it's ever going to get for Watches of Switzerland, in my opinion. So if we do start seeing that US start carrying on that growth that it already does have, and that profitability starts moving up with it, I think this will be a company growing at very nice rates a year, the profitability moving up, a decent balance sheet, 8 times earnings. Even if we start saying this company trades more towards a 13, 14 times earning business, that's still plenty of upside at today's share prices. never mind if we start factoring a bit of growth in, I could see this doing very well. So yeah, there's the element of risk here around the potentially that they don't actually own the products they do sell. But even when you take that risk in, when you look at the reward side, I think it does look very attractive here, and I am taking a very good consideration into watches of Switzerland now, and if I do pick some shares up. So this is very tempting on this list at the moment that I might pick some shares up in this one anyway. So I hope you enjoyed the video, guys. If you could hit that like button, if you're new around here, subscribe, and I'll see you in a bit.